Is Australia heading for a real estate boom in 2021? Keep watching. Hey guys, my name's Ravi Sharma and I'm the founder and buyer's agent here at Search Property. Thank you so much for joining me on yet another episode of Search Property TV. If you're new here, smash that subscribe button, hit the bell icon, and of course, leave me a like so that we can spread this video out to the people that really need it. Financial literacy is so important and we really need to get ahead and really spread the word. So on this channel, we talk about Australian real estate, the economy, and of course, financial independence. So if this is of interest to you, definitely subscribe and keep watching. So this is actually part 2 of a 2-part video series. So if you haven't watched part 1, which will be linked in the description below, as well as a pop-up card over here, you should definitely pause the video, go check that one out. So we built that context around why the property market hasn't crashed. And then you can come back here and see what exactly those pillars will really have in terms of an effect moving forward and what that means for Australian real estate, the property prices, and of course, the Australian economy as a whole, and how you can take advantage of this information and execute accordingly. So in this video, we're going to look at some similar pillars that have allowed us to hold up the real estate industry and exactly why property prices haven't come down and exactly what that looks like over the next year to the next 3-year period. Because I truly believe, and I have been saying this for a long time, even when COVID had just started, I was saying, look, I'm very bullish on property prices, not because I'm a buyer's agent, it's because I understand the fundamentals of the economy, I understand what's happening. Yes, there was uncertainty in the market, but this is exactly why now is the only opportunity you're gonna get to really get in. And I'm not saying that to, have you guys FOMO out. I've got plenty of people wanting our service already, so I definitely don't wanna be doing that. What I do want you to do is get serious about this. You need to start executing. You've been consuming information. Now it's about executing and taking control and accountability for what you have in front of you. This could be the best opportunity to be purchasing property again. It could be the best opportunity for you to diversify your income and build real wealth. If you're able to do it now in an environment where you can take advantage and leverage the experience of others, I definitely hope you take on that opportunity, because when I started investing about 6 years ago, I can tell you now, we had 5.5% interest rates. We didn't have all the building schemes. We didn't have all the grants. And we also didn't have the government just print out all of this money out of thin air. So it's very different to when I started, and I still managed to build a portfolio of considerable size. So now it's about educating yourself and take advantage of what's at play. So some of the main pillars that I want to cover off in this video that will really play a huge effect on the price action of property will be government stimulus and QE, 2008 versus 2021, interest rates and affordability, vaccine confidence, certainty with the US elections, more money and more savings, tax breaks and no stamp duty. So we're going to cover off each topic exactly how we did in part 1, and we're going to look at the cause and the effect of this. So it could be a lengthy video, but it really is about giving you some context and allowing you to really understand this. I'm not here like, some of the other YouTubers or maybe some media outlets that come in, give you a 30-second update of what's happening in the market. Now go run and do what you want. Now, of course, this is not financial advice. However, I think it's super important to get really comfortable with explaining and understanding these types of videos. Financial literacy is not taught at school. It's not even taught at uni. And if you're in a job that is so niche, you probably wouldn't even know what a mortgage is. So it's really about understanding how we can take advantage of different sources of information, start building your bank of knowledge, and take accountability for yourself. Government stimulus and quantitative easing. Now in part 1, we definitely covered exactly what that looks like. What we want to cover off in what the effects of property prices will be is inflation. So of course, with so much money being printed, money supply increases, and that effectively means the value of our currency is decreasing. Okay, so let's just take that in. So with inflation, which goes up, our value of the currency goes down. What some people could be doing in this situation is actually attaching money with hard assets, because the hard assets, being say Australian real estate, is growing at a higher percentage than inflation, which means effectively if you've got your money in a bank account and you're earning say 1%, but inflation is actually 2%, well, you're actually losing money. So most people think, oh, I'm gonna save my money and I'm making interest and it's amazing on this super savings account. it's actually meaning nothing. You're actually flushing down money down the toilet because it's actually not doing anything for you. Inflation is killing the dollar. What you want to do is then be attaching your money with hard assets that actually grow. So that's why we're seeing all-time highs with Bitcoin, seeing all-time high with gold prices, and now we're seeing Australian real estate, which didn't crash. And effectively, we are going to now come out and see what happened after the GFC is what is going to happen now. 2008 versus 2021. Okay, so let's paint the picture here. It was a bit different in 2008 where we had the global financial crisis. Now, I don't want to dive too deep into this. If you do want a specific video about 2008 and the recession we had, and then compare that to 2020, then I can definitely make a video. Definitely leave a comment down below saying I want that video, and that way I'll know, I'll definitely add it to my list. But essentially, the key point I want to take away from here is that during the 2008 global financial crisis, Australia had stimulus built in of about $100 billion. Now that is nothing compared to what we did in 2020. So in 2020 in Australia, we have almost racked up close to 700 to 800 billion. So almost 8 times as much debt in terms of with the stimulus and the quantitative easing that's going on at the moment. After 2008, what we saw was huge amounts of growth in the property market. Now, not everywhere grew, obviously, and Australia is not just one market that we generalize and say, oh, Australian property prices went up. No. We also don't even look at just capital cities and regional areas that grow, just all grow and every street grows. No, it doesn't work like that. There are specific areas within those suburbs, and that's why it's important to have the right team to assist you in researching. Now, so many people come here and think I'm here trying to sell you my buyer's agency service. No, that's not the case. I'm here providing the education for free. If you want help or you don't know where to start, then I'm asking you guys to definitely contact me. There is advantages to using a buyer's agent, and of course it's biased because I'm a buyer's agent, but I understand, having gone through this process of investing myself as an investor, now looking back, I know with hindsight, I could have done so much better with the help if I leveraged other people's experiences and expertise in those areas where they're familiar with, and you can take advantage of different economic cycles. So definitely take that with a grain of salt. You can contact me. My contact details are in the description down below, but that's as much as we're going to cover on that. Interest rates at all-time lows. Okay, so with interest rates, we're really having the RBA, right, our central bank in Australia, reducing our cash rate. What does that mean? Well, we're at 0.1%, which is the lowest it's ever been in history. That actually translates to lower mortgage rates because basically the banks are borrowing money from the RBA and that's how they get access to funds. So if they reduce their cash rate, we can reduce our mortgage rates at the bank. So now we're seeing lenders offer interest rates less than 2%. I go into this in a bit more detail with part 1 of the video, but essentially what that means is more money supply, people have more money because every month we're paying less for our repayments in interest. So now we can either spend more on eating out, we can either go on more holidays. Now obviously domestic travel's opened up in Australia, so you can definitely do that. But what it means is that people are now psychologically thinking they're wealthier. They now own the same property, but they're paying a lot less for it. And it also translates to capital appreciation. So if you're now able to afford a property worth 500,000 because the repayments now on 2% on 500,000 you can afford, well, 2 years ago, you couldn't afford that on even 250,000 because that's the equivalent. So as interest rates have kept going down, we've seen prices of property go up. And you can clearly see this in this graph. As we've had those cuts, it definitely affects the property prices and that capital appreciation. With all-time lows of interest rates in 2021 and moving forward, we've already had the RBA come out saying we're not increasing rates for the next 3 years. We've had senior economists come out and say the same thing. And I said this about 6 months ago, where I was saying, well, interest rates aren't going up and we're actually heading the other way. And it's so funny that now the banks are going and offering, 4-year fixed rates at lower than 2%. That is a huge indicator that we aren't going to see interest rates actually go up for the foreseeable future. Because look, banks are trying to make money, right? So they're not going to give you an interest rate lower than what they think it's going to be in 3 or 4 years' time. So they essentially are also pricing in the fact that interest rates will stay low and about to get lower. I've been saying it so often, especially on my Instagram page. So if you don't follow me, definitely follow me on there. But I talk about why I think interest rates will head into negative territory next year and in 2021 and 2022. And I think that is going to translate into lower interest rates. And as interest rates go down, we've seen it historically play out that capital appreciation, so property prices will increase. Vaccine confidence. Guys, there is so much talk about vaccines and so many other medical companies, and they're all coming out and saying, yes, we're very close to a vaccine. And what does that look like? Well, we've really gone through what is the most difficult time in the world for a lot of people. If you're younger than, I'd say, 60 or 70, you probably never experienced anything close to this. And as a result, our confidence levels have all been shot down. We always feel like we're going 2 steps forward, 3 steps back. There's lockdowns, there's people having new outbreaks, and COVID's everywhere, right? So if we now have a vaccine, which then allows us to go back to what life looked like 24 months ago or 12 months ago, well, now I'm taking up that deal. And as we get more confidence into the vaccine, we get more confidence into our businesses. The government starts opening up and reducing restrictions because they know that, hey, we're not going to have 200, 300,000 people die in Australia. What we will have is a small portion of people getting infected. But if we can manage this until the vaccine comes around, which maybe it's 3, maybe it's 6 months away, well, that means we can actually allow ourselves to shift. And then as soon as the vaccine comes, well, we've got certainty, people are going to feel more confident and actually go out, businesses will reopen and things will come back to normal. What does that look like though? Because if we've now gone through this period where we've just tried to survive, now things are back to normal, well, what are the changes? And those changes look like inflation, massive levels of inflation. You've got more money supply, devaluing our currency, and you've got interest rates at record lows, with then grants coming out and more support for owner occupiers and investors, and you have easing of lending restrictions. Are you kidding me? Like, we have all the ingredients now for what will look like the biggest property boom we have ever seen. And a lot of people have come out and said, no, you don't know what you're talking about. And to them, I say, go and watch part 1 of this series, where I'm talking about why the property prices didn't crash like so many people came out and said. Now, I'm not so bullish on the market that I say, hey, buy anywhere and it's all gonna go up. No, I'm not saying that. I'm saying if you carefully look at the economics behind why things are happening, why things will occur, the writing is on the walls. As I've been predicting, saying that, hey, interest rates will cut in this meeting, they won't cut at this meeting because of so-and-so reason, and what the budget looks like and what these effects look like, I've been correct so far. And so I have a lot of confidence knowing moving forward what 2021 looks like and the next 3 years as to why I truly believe that the markets that we're looking in and where I'm purchasing for clients, we're actually going to see significant growth. If you can go in and purchase a property with a 10% deposit on a $300,000 house, that's $30,000 in, right? I predict in some of these areas, we're going to see massive growth, which could be 10, 15, even 20% growth in the next year or so. And that means you're effectively doubling your money because 10% of 300K is also $30,000. So if you put 30 in and you've just grown by 30, well, that means your equity position has gone up. Your equity position has effectively doubled. Certainty with US elections. Guys, this is massive. Certainty is so important when it comes to markets and how they perform. So we saw this in Australia in 2019, where we had the Scott Morrison government come in. Now, if you see the markets, we were basically moving sideways and we were also declining in some markets because we had, APRA come in and they put all these restrictions for lending. Then you had no certainty around whether negative gearing was going to get scrapped and what sort of support the Australian government was going to show for Australian real estate. But instead, Scott Morrison comes in, their government comes in, and effectively that's when we had a new spike. We had really good growth in some markets for a few months before obviously COVID kicked in. And that's when things, sort of calmed down, people's confidence sort of tanked. What we're going to see is now we've had the US elections, we've had certainty around who is going to be the next president, being Joe Biden. But the biggest level of certainty we have is Donald Trump was not a normal president. He would do things that were very out of the ordinary. He could put up a tweet tonight, which could affect the markets tomorrow. That is not normal in most cases. So what we're going to see is with Joe Biden, I expect a lot more certainty, a lot more calmness, and a lot less of the erratic behavior that we did see and became accustomed to with Donald Trump. This all leads to the fact that more people will know that nothing's going to change overnight, and it means we know how we can plan for the next 6 to 12 months, and that's definitely going to play a part when we look at the overall appreciation of real estate in Australia. More money, more savings. Guys, I've been saying this for ages now, and I've covered this in part 1. During this period, when people were talking about unemployment and everyone's losing their jobs and businesses are out of work, there were other businesses that actually shot up. They've actually hit all-time highs. They've done so well that some people have actually got promoted and they've been hiring more people, right? So there are industries and there are people out there that have actually benefited from COVID and what the government has brought out. Some people are coming out more wealthier and they have better cash flow positions now because they're taking advantage of lower rates. So this will in turn lead to those people actually taking advantage and being on the attack, so being on the offensive, whereas most people are going to be on the defense and they'll be scared about reintroducing new practices and getting back into normality in 2021 and moving forward. So the people that have actually done well during this period, they've actually saved so much more money, not having traveled overseas. They're not actually buying luxury cars because they thought, oh, okay, I don't need to. And there's some people that I've been speaking to, clients that have come on board that had never thought about real estate, but now are thinking about it because they actually wanted to diversify their income. They were thinking, well, if I lose my job, do I make nothing now? Well, if I've got real estate and it provides positive cash flow, I suddenly have that income that comes through and it allows me to survive. So as a result, we've actually had clients come on board, purchasing property, and they've now made the 10% growth already in 3 months because we're buying under market value. And there's been capital appreciation. They're now taking advantage and buying 1, 2, or 3 more properties, and all in the space of sort of 6 to 12 months. Now, don't get me wrong. Real estate is not a quick fix. It is not something I say, go in and purchase 10 properties in a year and you can retire. But what I'm saying is if you time the market well by leveraging the experience of others that are doing it and doing it well, you're actually able to take advantage of the timing we have right now. These are not normal times. And that's where a lot of people are going to be stuck going, well, until I get confirmation because Channel 9 and Channel 10 are telling me I can invest now. It's taking advantage of that uncertainty because now we have confirmation that we will see huge amounts of price growth. And that's not me just being bullish. That's me being smart and being educated in the space to know exactly what's about to happen. Tax breaks and no stamp duty. Okay, if we didn't have enough government intervention into this free market, this is by far going to be the most effective. No stamp duty on New South Wales purchases, and I believe Victoria has now introduced something similar where they're reducing the amount of stamp duty paid. Guys, this is massive, unprecedented times, right? Well, 3 months ago, if you're following the channel, and if you haven't subscribed, you definitely should, and go watch those videos. But I was talking about, hey, guys, you think that the Australian government's got nothing left in the tank? You think they've got no other moves? Well, they do, and they started using them, right? So when we're at points of 0.1% as a cash rate, people are going, oh no, we won't go negative. We can't. So the RBA cannot reduce rates further. Well, you know, there's parts of the world that have actually gone into negative rates, and I believe they will go into negative rates if they need to. Similarly, when I was talking about stamp duty, some people said, no, they're not going to remove stamp duty. Are you crazy? Now they're removing stamp duty. So what I'm trying to say here is not that, hey, I told you so. It's more about saying, if you look at what's written in these papers, you're always going to be falling behind because you're always just relying on mainstream media. If you try and get educated, get aligned with the right people, obviously if you're here, you're trying to do that already. So I appreciate that, but it's really about taking accountability and now taking action because this is an amazing time. Easing lending restrictions and deposit schemes. So with easing lending restrictions, it was clear that they came out, Josh Frydenberg came out, our treasurer, and said, we're going to ease lending restrictions. We need to now put the accountability on borrowers. We can't sit there and sugarcoat things. We can't basically guide you through the process and say, well, I don't think you can afford it. Because even if you can, we don't trust you enough to actually make the right decisions because we think you're stupid. That's essentially what they were doing. So they put all these buffers into place when they, provided loan servicing calculators. And now what they're doing is going, whoa, hold up. Because as a result of that, this hard and fast rule, there are people out there that are educated, that are actually good investors, that actually know what they're doing, are actually not benefiting from purchasing property and creating wealth. At the end of the day, with real estate, the reason why we want to push for Australian real estate, and when I say we, the Australian government, the reason why the Australian government want to push Australian real estate so much is because they have less people relying on the government pension. So that means, hey, if you guys can go out there and figure out financial independence for yourself, that's awesome. Because when you need it in 30 or 40 years time, we don't want you having to rely for us to pay for it, because that doesn't look good on us. If you now have the property, awesome, like great. But that's why they are now looking at going, hey, we need to ease the lending restrictions. Let's open it up so that people can actually go and take advantage of these things. And we'll pull it back when we need to, because we need the economy to start moving forward. We don't want to be a government that's known for just a shitty economy. We want to know that we came out of the COVID restrictions, we came out of the recession, and look at how strong our economy is, right? What's a better way to do it? Well, 53% of Australians store their wealth in property. So let's just go and target that first. And that's going to create the wealth effect. Because in my mind, I'm going, oh, wow, I own my property and it's grown by 100K. Oh, I'll take that money out, buy a boat. Or, hey, I'll take that money out and let's start splurging. Let's go buy new couches, new cars. And that's effectively the mindset that the Australian government is trying to introduce into the Australian economy and to the Australian people like yourself. With deposit schemes, there is so much government grants and schemes available for people who want to buy. But it's so interesting how it's mainly targeted towards owner-occupiers. The reason for this, as a very, very basic level, if you want another video about this, definitely leave me a comment down below. But it's essentially around the fact that if owner-occupiers buy their own home, that's a liability, it's not an asset, so don't get that wrong. You purchase that, you now have to make the repayments. In order for me to make the repayments, I need a job. If I go and get a job, well, I'm supporting a business to be operating, but I also pay taxes. Now, the government makes money from the taxes, right? They know you have to continue working for at least the next 30 years because you have a mortgage to pay. So, you know what? Let's get more people into debt by going and introducing people to owner-occupiers, getting first home buyer schemes, getting more grants than ever before, and we're gonna introduce no stamp duty, right? So by doing all that, we're getting more owner-occupiers, more first home buyers that are effectively going, yes, we got a house that we couldn't afford last year. And with record interest rates being so low, they're gonna go, well, awesome, maybe we just, use the extra income to pay for stuff and the economy grows. What they don't realize, they're basically signing themselves up for a 30-year jail term where they're basically going, well, I'm ready to have to pay down this mortgage on my own with these two incomes, maybe you bought it with a partner, and for the next 30 years, I'll continue working. That's not something that sits well with me. And so my strategy, if you don't know already, there should be a card here and a link in the description below, where what I've done in my portfolio is I've gone and invested a lot, right? And I'm rent vesting. If you want a video about this, definitely leave a comment down below. But essentially, I'm going and purchasing investments, and then that will allow me in the next 5 to 10 years to go and purchase a property outright. So I'm not holding onto a liability, because a house that you live in does not provide you income. That is a liability. If you don't know Robert Kiyosaki's work, you should definitely go read Rich Dad, Poor Dad. I think it's such a universal book, so definitely go check that out. So guys, as a result, with all these pillars, all these things working together, these mechanisms that are coming together in the economy, I hope is painting a picture for you to understand why the mainstream media may not be talking about this yet. Because in 3 months' time, when they start looking at this data that's lag data, they're gonna realize that these areas of growth are actually gonna play a major factor in you growing your wealth. But by the time they start reporting on this stuff, by the time they start saying it's in the mainstream media and start putting it into papers and property magazines, it's too late. You don't want to be buying with unsophisticated investors. But what I'm saying is, when those things happen and people start focusing on those markets, well, if you've already bought property now, you start seeing that accumulate. And meanwhile, with our research team, we're looking at different areas. We're looking at what happens in the next 6 to 12 months. And that's when we're able to shift, pivot, buy in those areas, and be always ahead of the curve by 6 to 12, sometimes 18 to 24 months, so that we're not buying in a market that's literally rising to the top and we're buying up the top. That's too much uncertainty, there's too much risk. Part of my strategy and part of the stuff that I tell clients is that we need to diversify risk, we need to take actionable steps towards the end goal and be accountable, but we're gonna do that in the most sustainable way. I'm not interested in trying to go, hey, here's one property and now you've got 10 within 6 months. Awesome, like we did that. No, I'm interested in reducing your levels of stress and anxiety and get you to a point where you're actually learning the process, you're learning as you go along. And as much as I'm a buyer's agent, I'm also a property coach. So along in that journey, I'm there to support you, to get you to understand how important this is, because school failed us, your parents may have failed you, your social circles may have failed you, university failed you, your job may fail you now, but Search Property TV is where you want to be. So if you're here and you enjoy this content, definitely leave me a like down below. Share it with someone that you know can definitely benefit from this. If you've watched all the way through, I really do appreciate it. And as always, guys, take action. If you want some more content from me, follow me on my socials, and I've also got a private Facebook group, so definitely join me on there. Guys, thank you so much for watching, and I'll catch you guys in the next video. Thanks, guys.